Okay, good morning to everyone. Today is Thursday, the 30th of October, and we're going to spend some time today talking about the remainder of the content from Chapter 8, which deals with issues concerning inventory. And inventory is really an important topic, really, in intermediate accounting, in financial accounting generally, because of the idea of how we evaluate, how we do the valuations on inventory, and the differences in reported income based upon the different methods of reporting the valuation of inventory. So it's a big issue, and it's been a big issue for a long time. We'll also sort of try to reconcile some of the differences between our GAAP standards, which allow the LIFO system, which I think you're all familiar with now, and other methods, FIFO and average cost method, and how it's a big controversy when it comes to sort of reconciling the GAAP standards, which are domestic standards, frankly, with the international standards, which do not allow FIFO, or I'm sorry, do not allow LIFO. And so we'll talk more about that. So just a quick overview here as to what's going on this week. The Smart Book quiz is available. It's due for tomorrow, I guess. I was going to say next Friday. Tomorrow, which is 10:31. And so that's been available. A number of you have already completed that. That's great. And then Chapter 8 homework also due by 11/2. The second exam, which covers Chapters 6, 7, 8, is going to be available on, it was available now. It was going to be due by Sunday. So keep in mind that is coming due. I know that I sort of push things back a little bit, but I really want you to have more time as opposed to less time. And I know not everybody likes this particular approach, but in my mind, it sort of it's a little bit of something for everybody, because if you want to work ahead and work faster, you can do that and get some of this material done prior to the exam. But if you don't want to work faster, you have more time to do it, more time to read, more time to study. My feeling after having done this for a very long time, having been in college and graduate school for a long time, is that students appreciate more time as opposed to less. I've never heard somebody say, move things up. I want to get, and whatnot. So that's kind of my approach. So exam 2 is going to be available. And if you have questions about the exam, let me know. It's going to be done in Connect. And it's basically a lot like a homework assignment, only a little bit longer. And it's going to deal with these three chapters 6 through 8. So, okay. If you have questions, let me know. I'm here every day, and I'm here to help you. And if you have questions, I'm more than glad to work those out for you. Okay. All right. So we're back to Chapter 8. We're talking about inventories. And I think where we left off was here last time. And I think we have a really good shot at getting through all of this today in the class session, because there's not a lot more to do, except for the fact that we need to sort of drill down into some of these differences in terms of inventory valuation methods. And so what are the choices that we make in terms of whether we use FIFO, whether we use LIFO, average cost, retail method? I mean, there are other kinds of methods that are out there. Obviously, FIFO and LIFO are the headline grabbers. I think most of us know it. In fact, every business student, I think, who's ever taken any kind of business courses that involve accounting, pretty much know what FIFO and LIFO are. But when we get to LIFO, we get some other sort of quirky features that we're going to sort of talk about here. So what are the choices that we're making? Well, number one, what is the cost flow assumption that we're going to make? Now, I don't know that this is a particularly compelling view on the part of management. I think sometimes the cost flow assumption doesn't match the physical flow assumption, or the physical flow reality. And that's one of the things that we talk a lot about when we talk about FIFO and LIFO, is that sometimes it doesn't make any difference what the physical flow is. It really has more to do with what is most advantageous to the firm. And one of the themes that comes up again and again and again in intermediate accounting is the idea there's no one-size-fits-all solution to every particular business's needs. And so businesses have different needs at different times. And so as a result, they're going to choose different options, whether it's depreciation of assets, whether it's inventory cost flow methods. I mean, the list goes on and on. So as to what we're doing. So those are some issues. Pension assumptions and really relate to the idea of how much of net income is deposited into pension accounts. And by the way, I think your book alludes just a little bit about union contracts, where we want to make sure that net income is a driving factor in terms of union compensation, and particularly in terms of sort of profit sharing arrangements. Well, if you're depressing profit because of LIFO methods, which is a factor that does go on and it's done for tax purposes, then how does that affect contributions into pension plans, profit sharing plans, bonuses, those kinds of things? And so we'll get to a little bit of that. Some of this kind of takes us a little bit out of intermediate accounting, but nonetheless, these are important considerations. So let's talk about this idea of what are the appropriate choices that are being made. So some of this involves, what is the physical flow? So FIFO best suits the physical flow. I don't think there's any question in the vast majority of cases in which companies have inventory that FIFO makes the most sense. Anybody who's worked in any kind of situation in which there's inventory knows that you want to sort of rotate inventory to sell the oldest stuff first and the newest stuff last. And as new stuff comes in, you sort of move that to the back and you want to sell the oldest stuff. So FIFO makes sense. It's the most logical flow. However, it's not exactly conforming to what we do in terms of LIFO. So in fact, it's just the opposite. So if inventory comes from a mixture of goods acquired at various times, such as liquids, chemicals, things like wine and beer and whatnot, who knows when this stuff came in, the average method would be more correspond to actual physical flow. The average cost method has got lots of advocates, and for the simple reason that sometimes LIFO is not necessarily the wrong way to go. And I think I mentioned in the last class session that among the passionate defenders of LIFO was Walmart, who said that, look, it really resembles our inventory flow. We get stuff in, it's gone. Get it in, it's gone. Get it in, it's gone. If it's old, we don't sell it because nobody wants to buy it. It's banged up, it's got a dent in it, somebody stepped on it and whatnot. So there are passionate defenders of LIFO, but to sort of split the difference here, average cost might be one way to go through with it. So, and there are in fact very few inventories that flow in a true LIFO manner. And I know that for years and years, textbook publishers talked about things like mining operations, where you mine a certain coal and you put it on a big stack of things and you pull it off that stack or that mound of whatever. But there are really not that many inventories that make sense in a LIFO manner. And this is, I think, one reason why LIFO is not allowed under the international standards. And we'll talk about what companies do when they have to report, both in terms of GAAP accounting, which does allow LIFO, and international standards, which does not. So it is not mandatory that we match the physical flow with the actual inventory flow. And this is something that I think is surprising to a lot of people. It's something that it seems illogical, and we're teaching business school students the idea that it doesn't really make any difference what inventory flow is. We don't really care what the cost of goods sold are. We're just going to make an assumption as to what those cost of goods sold are, and hence net income is going to be affected by that. It's a lot to take in, but sort of welcome to the world of inventory valuation. So one of the big issues is net income. So if the cost of inventory changes, the method that we are going to choose really impacts the amount paid in taxes. And so when we talk about LIFO in particular, really the major advantage by far is the cost savings in terms of tax, the tax liability. Because what LIFO does is essentially reduce net income, right? And as a result, reducing net income, reducing the tax liability. And I know that sometimes people say there's something called the LIFO conformity rule, which I think we're going to talk about here in a second, that says that whatever you do in taxes with regard to inventory valuation, it's LIFO, FIFO, whatever you're going to have to do for financial reporting purposes if you're a public traded company. In fact, I think it applies. It's even not non-public companies. But nonetheless, certainly for publicly traded companies, if we use LIFO for tax because we will reduce our tax liability, we also have to use it for financial reporting. Now, here's the tricky thing, and we're going to, I think, get into this a little bit more later, is the idea that users of financial statements, which again, financial accounting primarily deals with external use of reports by financial analysts, bankers, lenders, investors, and whatnot, and they are able to sort of convert LIFO to FIFO if they think that's a more realistic way of doing it. I know I certainly did, and I was required to do it. I was a very young financial analyst. We get companies reporting it under LIFO, and yet we would say, well, that doesn't really make any sense what about the FIFO accounting? And we would simply convert it. And one of the things that comes up again and again in terms of the usage of financial statements is that users can do whatever the heck they want with it, right? It's their own information. It's public information that's available to everybody. I am sure maybe 1% of the population drills down into these Edgar reporting statements, but for those who do, we're interested in what's going on, and we can make adjustments as we need to. And because we know that sometimes some of these things are due to tax reasons, and being a tax accountant, I'm very familiar and sensitive to this idea. So we can make those adjustments. We can do the conversion. And the conversion is not as difficult as what it might seem. And we're going to get to that here in a second, okay? So taxes are a big issue. We talked about the LIFO conformity rule and the fact that companies choose LIFO in order to reduce taxes. And why would they do that? It's mostly in periods of rising prices or rising input costs, primarily inventory costs. So if you're doing that, why would you do that? Because you're saying we're selling the most expensive goods first, right? And as a result, we're going to reduce net income, right? And so we're saying the last goods in are the first goods out, and the oldest goods are they're still sitting on shelves, right? And so as a result, we're raising our cost of goods sold. If we raise cost of goods sold, we lower net income. And as a result, we lower the tax liability. And it's this is not new stuff. This has been going on for as long as I've been around. I've been doing this for a long time. But users of financial statements know that if companies use LIFO, even though it has no bearing whatsoever to the physical flow of actual inventory, they're doing it because of tax purposes. And I think I showed you on Tuesday an example of Kroger's financial statements. Kroger is the nation's largest retailer, grocery retailer. They also, I think, own Fresh Market now. Smith's subsidiary, King Soopers, Vons. I mean, they're really all over the place now. But there's a LIFO system for groceries, which are going to expire very quickly. So they may have inventory that's been on the books for, I don't know, decades, maybe, right? Things like lettuce or Swiss cheese or whatever. And this is, and I will tell you just from my own personal conviction that I think it makes sense why LIFO is not allowed and under the international standards. And we'll talk about some of the challenges that LIFO presents. Even though LIFO has its very passionate critics. Now, keep in mind that, and I know your text talks a bit about this idea of the effort to sort of converge GAAP standards to IFR standards. And it sort of it made some momentum, and it's still sort of going forward a little bit. It's baby steps. But it kind of one brick wall it hit was this idea of inventory evaluation. And as your text talks about, there are companies out there that have for decades now accrued, inventory evaluation and have what we call inventory layers, and we'll get to that in a second. That if we changed overnight to FIFO, it would really result in a huge disruption in their business and their financial reporting. Tax consequences would be, incalculable. And so as a result, we're sort of stuck with the system we've got. So, and LIFO's got its own complications. And I know both as an accounting student, as well as an accounting instructor, LIFO is one of the more challenging subjects. And so we're going to talk more about that because it's got a lot of different twists that are involved in it. So, and one of those is something called LIFO reserve. Okay, so let's talk about what LIFO reserve is. LIFO reserves are essentially the difference between the value of inventory that would be priced at FIFO and that, or FIFO or average cost, whatever the case might be, and LIFO. Okay, so that's what LIFO reserve is. It's simply it's a contra asset. So so we put inventory in the books as a debit balance, and we have a credit balance account called a contra asset. It's called LIFO reserve, and it's called a lot of different things. And I'm going to pull up here, just because we're on the subject of Kroger. I want to sort of pull up their financial statements here and see if I can find it here. It was a little late getting started because I was trying to pull up these statements here. So let me go to financial statements and supplementary data. And we have, okay, here we go. Right. So, and this is really hard to see, I know, and I'm going to try to blow it up as big as I can here. But so we have, went too far. Let's see. Okay, here it is. So I think I still went too far. I blew this up too much here. But we're going to have an allowance for for the LIFO, which we would refer to as LIFO reserve. So we have a LIFO charge, which is that credit to inventory, which is offset then by a debit to expense. And it's really a reduction in net income as a result of that. So, and here's what we have with regard to the LIFO charge. But I want to show you, I thought I was going to get to it. I think I made this too big, so made it a little hard to get. Let me go back here. I apologize for the delay here. I had this sort of queued up here and I made it bigger because I know it's hard to see. Let's go to the balance sheet, right? So let's go to consolidated balance sheet for Kroger. This was as of 2024. Here it is. That's what I'm looking for. So FIFO inventory. So under current assets, right? This is a balance sheet, right? So, oops, let me drag it out. I'm talking about this and you can't see what I'm talking about. My apologies. Sorry about that. I'm bringing it over. I will bring it over. Okay, so here's what we got in terms of. Go back up. Oh shoot! I just lost it. Okay. Hold on a second here. They've got these settings here really big. Okay, here it is. Okay, so now you can see it. All right, so here's the balance sheet for Kroger as of year-end 2024. We can pull up more current data or whatever, but we have FIFO inventory, and we get this thing. We dropped off 6 zeros, and so we have 9.4 billion in inventory, and then we have a LIFO reserve of 2.3 billion. This is an accumulated figure. Okay, this means that the difference between FIFO and LIFO inventory valuation is accumulated over time. And so these numbers, this is not a small number. $2.3 billion is not a small number whatsoever. And it simply represents the difference between valuation using, in this case, FIFO, net average cost of FIFO versus LIFO. And what is it really saying? It's saying that because of the fact that we're valuing this inventory differently, we want to sort of include this as a sort of a separate disclosure here. So LIFO reserve is something, it's an accumulated figure that builds up because the difference between FIFO and LIFO inventory valuation is considered a contra asset. That doesn't mean that we can't go the other direction where we sell more of the goods which are in what we call layers of inventory. And when we do that, we'll talk about what the adjustments are in terms of the accounting figures. But that's essentially what's going on. So LIFO reserve can go on and on and on and on. And this is something that financial analysts know to figure out. And they understand it. They understand why it's going on, and they understand why companies use LIFO, because of the fact that the prices of goods tend to rise over time. And by the way, I think we talked a bit about this in Principles 1. LIFO works as a tax reduction tool when prices are rising. It does not work when prices are falling. It goes the opposite direction, right? Because then you're selling goods which are less expensive, and so as a result, you're going to boost net income and hence boost tax liabilities. So it really works in a period of rising prices. Now, what's really interesting about this is the idea that for a long time, we didn't really have very much inflation in the economy. It was sort of patchy. It's a big economy. We got a lot of different suppliers across a lot of different sectors. And so, in some areas, prices were rising, some not so much. But sort of on a macro basis, prices weren't really rising very much. And so LIFO really wasn't that attractive. And particularly when you add all the complicating factors of how you do the accounting for LIFO, it really wasn't that attractive, which meant that a lot of companies until fairly recently were dealing with a FIFO basis. And if they chose FIFO a long time ago, they're probably stuck with FIFO. But LIFO is still around, and it's probably now that we're in a bit of an inflationary environment. We are. We're about 3% annually, annualized inflation from a macro environment. So, it affects different industries differently, but I think there's a lot more incentive now for companies to use LIFO, simply because of that, right? But the one thing I keep coming back to is the idea that users really understand what's going on with regard to that. So, okay. All right, so let's talk about this idea. So the LIFO reserve, the reason to maintain the records using LIFO is because there are high record keeping costs, and there really are. LIFO is it's kind of a pain to operate, right? And it requires lots of effort, lots of work, and it's not as easy as FIFO or the average cost method, certainly. And then we talk about the contractual arrangements such as bonus or profit sharing plans that calculate net income with a method other than LIFO. So it has long been asserted by unions and by employees and by even by managers that if we use LIFO as a method of valuing inventory, to the extent that the firm uses inventory as the means of earning profit, that if we use LIFO, we're going to depress earnings, and so therefore we're going to depress the amount of bonuses and profit sharing that are occurring to employees, non-management, management alike. And so as a result, FIFO will be used in those particular issues. And so, and there's been lots of controversy over how we report income. Certainly things like motion picture industry, the recording industry is notorious for using different sorts of weird accounting tricks in order to reduce net income, to reduce things like royalties and whatnot. So there are lots of issues. There are lots of arms and legs that go a lot of different areas here, lots of branches of inquiry. But the idea is that sometimes those who are most affected, as insiders, will want to use FIFO because it boosts net income and hence boosts their overall compensation. For those who are receiving bonuses based upon performance, that is company-wide performance, and so as a result, LIFO is going to depress those, and so you can get rid of those back to the LIFO. But LIFO is certainly an area that is used and is used a lot. Okay. All right, so here's an example. We have DoubleTree Corp, but I don't think this is the hotel chain because it's an inventory company. So they began 2021, so this is the first year, with a balance of 475 in this LIFO reserve account. This balance means at the beginning of the year, the inventory balance under LIFO is $475,000 lower than would be under FIFO. What does that mean? Well, it's the cumulative difference, right, that between FIFO and LIFO estimation. And so this is what we call LIFO reserve. It's a contra asset that we simply book under inventory. And so by the end of 2021, assume the difference is now 535,000. In other words, it's grown by 60,000 from 535 here to 475. So what do we have to do? We have to increase the LIFO reserve, which is a credit balance because it's a contra asset, and we debit or increase cost of goods sold. Remember, cost of goods sold is an expense, so increasing that means a debit. So that's the adjusting entry that we make at the end of the year for that particular reality. Okay, the idea that we are adding to LIFO reserve because of the fact that we're selling goods under a LIFO system, but we also want to maintain a FIFO accounting system in order to sort of reflect the difference. This is not uncommon whatsoever in terms of financial reporting. In fact, any company that has inventory whatsoever, particularly if they're using LIFO, is going to go to great lengths to explain what is going on in terms of how we account for the LIFO reserve. The LIFO reserve is simply that amount, and it's a cumulative balance over time. It doesn't mean it can't go down, because it can go down, and we'll get to some examples of that. So, and I think this is the example that we want to talk about here, and that is we have books a million, all right, and so we have a disclosure note for. It shows the note, the company's values were inventory evaluated at FIFO, and which is the internal method. And we say internal method because this is not what's reported to external users, even though we may report that in a note to the financial statement. And less the LIFO reserve, which is this. So inventories minus the LIFO reserve, which is a contra asset. And so we have this amount, 15 billion 278 as of 2017. And it actually went down from the prior year, because the prior year we actually had a greater amount of LIFO reserve. And this brings us then to what we call LIFO liquidation. And this is where we start to reverse some of the cumulative effects of the LIFO reserve and the LIFO valuation application generally. And this is one of the things that we talk a lot about in intermediate accounting, is the idea that we can reverse some of the differences, the valuation differences between those. And so in this example, in 2017, the LIFO reserve went from 1.012 million, which is basically 1 trillion. I'm sorry, 1 billion. I keep saying trillion, 1 billion to a little over 1 billion, but it's about was it $70 million difference or $7 million difference. So we're gonna debit LIFO reserve. Remember, this is a credit balance account. We're gonna debit it because why? Because we're cutting in to that LIFO reserve. Because why? Because we're selling more inventory than what we actually purchased. And remember, what is the assumption of LIFO? That we're selling the newest stuff first, the newest goods first, and we're selling the oldest goods last. So, but what if we've already sold out of the new stuff and we're moving into the older stuff or inventory, whatever you would call it. And so we're sort of cutting into it. And so as a result, that LIFO reserve gets whittled down. Not a big dollar figure here, but nonetheless, we're getting into it. And this is what we essentially refer to as a LIFO liquidation. I'll get to it in a second. But so what's the transaction here? We're gonna decrease cost of goods sold because we're gonna have a credit to cost of goods sold. Now, whenever you say a credit to cost of goods sold, which is a debit balance, right? Well, it's because of the fact that we're now moving into a LIFO liquidation, and therefore we're going to increase reported profit as a result of this. So this is a little bit different. This issue of LIFO liquidations is really important for us to understand what is really going on with LIFO generally. So let's talk about LIFO liquidation and what it means and what are the implications of that. So under LIFO, remember, what are the assumptions? That we're saying that the last goods in are the first goods out, right? And again, there are passionate defenders of this particular methodology that says, yeah, we get stuff in, it's gone, in, out, gone quickly, right? And some of the older stuff doesn't sell because it's old, it looks old, it's expired, we're gonna write it off. So I'm not discounting the wisdom and logic of LIFO because they've got some passionate defenders who have argued vigorously before FASB to sort of keep this. And so I don't see LIFO going away. So if anybody here who's going to be studying for the CPA exam, LIFO is something you really got to get your arms around because it's an important topic. And it's used in a lot of different cases, particularly in companies doing lots and lots of volume in merchandise. Not as much in services, it's not that big of a deal, but certainly as inventory, and it's not just physical goods in boxes, but it's things like oil and gas and agricultural produce and all those kind of things. So, all right, so that's the assumption here. In some periods, the units sold will be greater than the number of units purchased. So what does that mean? It means we're moving up the food chain here. We're moving up the purchase chain. In other words, we're cutting into layers of inventory that were purchased sometime previously. So as a result, we're going to sort of liquidate what we call layers of inventory. And we're going to do it. And I know that I mean, we could do a year or 2 years on LIFO and on all this, and we really could. And we just don't really have time to do it. It's one of those things that we, even in intermediate accounting, which we considered sort of an advanced accounting course, there are a lot of things that go on with LIFO that we need to know about. But what we're really saying is the idea that we're sort of moving our way to liquidating inventory, selling inventory. By liquidating, I simply mean selling it. That was older on the books. So we're moving up the purchase chain here and picking up older goods. Now, it also means that in an inflationary environment where the older goods purchased are less expensive than the newer goods purchased, well, that's another issue. And we're going to get to that here in a second. So what we're doing is we're liquidating layers. That's what inventory liquidations, LIFO liquidations are all about. And here's the problem. The problem is that as you start to liquidate inventory, and by the way, there are cases, and when I say that it's a complicating factor, you've got some businesses that got thousands of SKUs, stockkeeping units, where the experience in terms of LIFO liquidations may be quite different depending on what good versus some other good. Now, we try to solve that problem with what we call pools of inventory and whatnot, but nonetheless, the issue still remains. You can sell out of some goods, and as you're selling out of those goods, you're actually liquidating inventory, some of which was purchased at lower prices, which means if it's sold at lower prices, cost of goods sold is going to be lower than would have been otherwise. Net income is going to be higher, and so this is really the big issue here: is what's going on with prices, right? Input prices. In general, I think I'm not on shaky ground. All to say here that prices tend to go up over time as opposed to going down. In general, that's a very generic statement. I get that. Yeah, there are some goods that prices go down over time. There are some goods that are really, really volatile. Energy, like oil and gas goes up, goes down, and whatnot. But for the most part, prices tend to go up over time. It's just the way our economy works. So as a result, if we're moving into liquidating these layers, we're actually we're cutting into goods and we're selling goods, liquidating goods, in other words, that are of a lower price. So it's going to have an effect on net income, and that's one of the problems with it. And believe me, I'm very sympathetic to the objections of the IASB, the International Accounting Standards Board, to LIFO generally. I'm sympathetic. The problem is we've been using, under GAAP accounting, we've been using LIFO for so long that it's difficult. I mean, I suppose we could transition away from using LIFO period to some other method. It would probably take time, a lot of effort, a lot of work on the part of accountants. And I think most business firms here that are domestically based wouldn't want to do it. And well, I don't think this is at all a controversial statement. I know they don't want to do it, so it's going to require a lot of effort. So we are what we are with regard to LIFO. So let's talk about LIFO liquidation. So in this example, National Distributors uses LIFO, and they began the year with 20,000 units at $16 per unit. Okay, so this is one layer. This is the beginning layer of inventory. And they had purchases of 30,000 units at $20. So as a result, different prices, right? And again, we're making the assumption that prices are going to go up over time. So total units available for sale 50,000 and a price of 320 plus 600 is 920. And by the end of the year, 45,000 units were sold. Under the LIFO assumption, cost of goods sold is determined as what? Well, all right, well, we sold how many units? We sold 45,000 units. So it must have been those, it was 30,000 of the last purchase, right? Plus, we're going to cut into about 15,000 units from the beginning inventory. And I would assume we're using the perpetual system here, which would make a lot of sense. But nonetheless, here's what we do. Here's the math here, right? So it's costing us. So we sold 30,000 units that most recent purchase. And then remember, beginning inventory was, I think it was 30. Was it 30,000? Let me see it. It was 30,000 units. Or I'm sorry, 20,000. I think it was. And we're selling 15,000 units of that. Yeah, it's 20,000. So as a result, what do we have here? Cost of goods sold is simply this: these two layers of inventory. This is what we mean by inventory layers. And again, we can take this across a lot of different items. 12-ounce ketchup versus 24-ounce ketchup, or whatever, and do this again and again and again all the way across the spectrum if we're dealing with inventory. So we sold 45,000 units, and again, it's quantity times price, so 840,000. So inventory, any inventory then equals $80,000 because we have 5,000 units remaining, and that 5,000 units remaining was at the original price, right? Remember, LIFO assumes that we're selling the newest goods first and the oldest goods last, and so as a result, the 5,000 units on hand were at $16. So 5,000 times $16 equals 80,000, and that is in the inventory, assuming this is the only activity for this accounting period. And again, this is a very simplified example, but hopefully we're communicating the idea that we're selling the oldest goods. We're selling the newest goods first, and we're not selling the oldest goods. But what we're illustrating here is the fact that our sales exceeded our purchases in that accounting period. That's really the key thing to know here. Because remember, we bought 30,000 units, but we sold 45,000 units. So we're breaking our way into the prior layers. This is what we call LIFO liquidation. We haven't completely liquidated that beginning inventory of 20,000 units, but we're on our way to do that, right? Now, as time goes on, we're going to have new purchases and whatnot, so we're going to have new layers that go on and on and on. So, and I guess, well, I was going to say theoretically, but not theoretically. If you are going to sell out of every particular good in a particular area, when it sometimes comes about when companies say, we no longer want to make this good, and so we're going to sell it, then we would simply liquidate layer upon layer upon layer upon layer as we go up the purchase chain in time, and that good has been completely liquidated. And it does result in distortions of net income as a result, particularly if there are large variances in price over time. And there are some goods where the variances are large and some which are not, but nonetheless, the attraction to LIFO is to ultimately reduce net income. And for tax purposes, that's really the main issue. There are a lot of headaches involved with LIFO. And I don't mean to oversell this, but it is something that I will tell you that it's been a bugaboo of a lot of students, even graduate students over a long time, as to what we do with LIFO accounting, because it is a bit challenging. So, all right, quick question here. So Dwell Corp has adopted LIFO as of 2021. Its first year, this is important, Dwell has disclosed that if FIFO had been used, inventory would have been $36 million higher than the inventory determined using the LIFO method. So in other words, there's a $36 million difference between the FIFO inventory method and the LIFO method, which means the LIFO reserve is going to be 36,000. But the question is, what is the tax effect? Now, this is something, and I know that I've talked a lot about the fact that we don't get into a lot of tax questions in intermediate accounting. But as a tax accountant, I can tell you, it's really sort of hard to divorce oneself from tax implications. Certainly when we talk about LIFO. I mean, of all the headaches that LIFO involves, there's got to be some payoff at the end to use it, and that's because of the tax savings. So what is going on here? So, well, first of all, we have to take the tax rate, 40%. We have to take the complement of the tax rate in order to determine the effect of what's going on here. So the LIFO reserve is 36 million. So the answer is going to be B, and that is the idea that we take 36 million, which is the LIFO reserve, which is essentially the income savings in that year. It's the first year, which makes it easy. And we're taking the complement of that. So 1 minus 40%. Now, the tax rate is no longer 40% on corporations. Yeah, for domestic corporations, it's 21%. But nonetheless, let's not worry about let's just go with what's given here. And we're going to end up with 21.6 million. And that is what? And that is the difference of tax that's going to be involved here, right? So it's an important thing to talk about, right? This is the amount that is saved. So you can understand why companies would want to use a LIFO reporting method simply because of those particular savings. Okay. All right. I don't think we have anybody on the call here. Well, maybe we do on the call here. Any questions before we go on? I think we have nobody in the classroom today. That's fine. It's perfectly fine as to how you want to attend class. That's why we make this available. So, all right, let's go on to talk about inventory management and what's going on here. And then we're going to sort of get about 35 minutes, and I think we can get through that and talk about the rest of what's going on here. So when we talk about inventory management, what are we talking about? We're talking about monitoring inventory very closely. And there are conflicts occasionally involved here. And that is, and this is something that is not valuation related. So let me just note that we're sort of shifting gears here. And that is the sort of an overview of what inventory management involves. It's complicated. Remember, inventory itself is an asset account, right? And it doesn't release expense until the good is sold, meaning that we're tying up a lot of expenses, particularly in the manufacturing context, where we have wages and materials that are sort of bound up and capitalized. And we say capitalized, and that is when we put it on the balance sheet on the asset side until that good is sold. And when the good is sold, then we lower the asset for the amount of that asset, and we only then recognize cost of goods sold at that point. But here's the thing about inventory: managing is costly, and we have to insure it. We have to make sure it's protected. We got to keep it dry, and we can't let somebody run a forklift through a pallet that's going to damage inventory. It does happen. It's not that uncommon whatsoever. We got to protect against theft and all of that. We have to maintain security systems, whether it's a wholesaler or retailer, by the way, or a manufacturer. I mean, we can go all the way up to the production chain here. We have to sort of guard our inventory because inventory can go missing. Now, raw materials, not so much. I mean, people are probably not going to take off with chemicals or screws or whatnot the way they are with things like stereos and TV sets. But you get the idea that one has to sort of guard against this reduction in inventory, which we often call shrinkage. But it's beyond that. Okay, it's beyond that. Those are obvious issues that come up with regard to inventory. I think nobody here needs any convincing that we should guard our inventory for whatever we need to do, cameras and alarms and all that. But there's a bigger issue that concerns how we fund inventory. And then is inventory sitting on shelves and in warehouses and on pallets doesn't make us any money whatsoever. And as a result, we want less inventory, not more. And so there's been an effort on the part of really all firms, for the most part, to have as little inventory on hand as possible. Yes, there are some exceptions where companies, particularly high growth companies, want to stack it high and let it fly. But that's where inventory is still flying off shelves, and you can't sell what you don't have. But for the most part, particularly in the manufacturing context, we want less inventory as possible. And one of those techniques is something called GIT, which has been around for some time. It's not new at all whatsoever. I had an uncle who was a supervisor at Alcoa manufacturing plant back in the 80s, and we toured, and they said, we're using JIT. We want less inventory, not more. The idea being that we get raw materials in and things move, and nothing sits. We move inventory. We want as little inventory as possible. This maybe impossible goal, but nonetheless objective of zero inventory. So because inventory doesn't do anything for you. It eats up cost, it eats up resources, and we want less inventory as opposed to more. And that may not sound completely logical, but the idea is that inventory sitting around doesn't do anything for anyone whatsoever. So we need to kind of move inventory. So JIT is this idea of moving it quickly and keeping it going. There have been examples, and I've been studying JIT for a very long time, where the idea is you get goods coming in, receiving, and they're moving, they're not sitting, they're moving into production, moving through production to finished goods and out the door to a truck somewhere or to train, whatever, and they're on their way out, right? And you get the idea that companies do not want to have a lot of inventory. An example here of Harley Davidson is great. I know one of the CEOs I worked for was a huge fan of Harley Davidson. He was a banker. He was a huge fan of Harley Davidson. He just loved their business model. If you order a Harley Davidson, you're going to wait for a bit because they're going to put it together. They don't have the inventory sitting on hand in order to make it. And I think the same goes for like Dell computer. I don't know how that works now with Dell, but used to you go online, order a computer, and they would sort of mail it to you or UPS it to you, but they would put it together as a customized manner, and they would try to, I think, have as less inventory on hand as possible, because inventory doesn't do anything but eat up cost. And this is something that if you've talked to business owners before, they'll say that all my cash is tied up in inventory, right? And we've heard that refrain again and again and again. So this is one way to sort of avoid that. Remember that the overall topic of this module is inventory management. So JIT is one of those. There are a lot of other methods as well. Flexible manufacturing systems, which are this idea of moving workers around different areas and whatnot. And a lot of different areas that are involved with trying to reduce inventories. Okay, we talk about ratios. This is something we got to a bit in Principles 1. I think we actually carried over to Principles 2 because we sort of rolled what was Chapter 10, which would have been Chapter 10 in Principles 1 over to Principles 2. And it's this idea of gross margin. So two different things we should talk about here, just to be clear. When we talk about gross profit, we're talking about a dollar figure. That's net sales minus cost of goods sold equals gross profit. So those are income statement figures. Gross margin, however, is the percentage of gross profit divided back into net sales, right? And that's what the gross profit ratio is the same as the gross margin. And I know this is something that people get confused about a lot, and that's the idea. Gross profit is a dollar figure, gross margin is a percentage. So the gross profit ratio, I would much prefer they simply call that gross margin, because gross profit margin is the same as, gross profit ratio is the same as gross margin. So it's simply gross profit divided by net sales, or net sales minus cost of goods sold equals net sales. It's this is what the margin is, right? And the higher the ratio, the higher the markup achieved. And that's the good thing, right? Companies always want higher markups as opposed to lower markups, right? And when we hear businesses talk about declining margins, we're almost always, unless they're very, very specific as to some other metric, they're talking about this idea of what are our gross margins? Are they declining? And we see this sometimes where companies maybe don't have pricing power, so net sales is affected, or their cost of goods are rising and they can't control those. Both of those are recipes for declining margins. In other words, declining percentage returns. Okay, so the higher the ratio, the higher markup achieved. And when it comes to gross margin, the higher the better. And when we talk about this idea of declining ratio, it's the two factors that I talked about. It's either a pricing issue or it's a cost issue, neither of which maybe can be resolved. And there are lots of examples of companies that simply cannot overcome these difficulties with regard to gross margin. They might be difficult. The airline industry is a classic example where they have fuel costs that they really can't control, and because they don't control the price of jet fuel, which is a derivative of fossil fuels. They don't have any control over that. It's not like they've integrated backwards to control the supply of oil. Maybe they should. I don't know, but you get the idea that they really can't control that particular price. And so as a result, gross margins periodically suffer as a result. Or maybe they can't increase prices because there's too much competition, or people are not flying, or whatever the case might be. That's just one example of cases in which companies are up against some difficulties with regard to gross margin. This leads us to turnover. So we're not going to do a lot of ratios here. Some of this was covered earlier on. We talk about inventory turnover. We're talking about simply the cost of goods sold, which is the value of inventory. Remember, we book things on our financial statements and the cost of those goods, right? And inventory is an asset until it's sold, right? And when it's sold, we simply say, what is the value of that asset, inventory, divided by average inventory, and it gives us inventory turnover ratio. The higher, the better, because the higher means the more effectively a company is managing its inventory. Now, obviously, there are a lot of goods that do not move quickly. Very high ticket items, inventory turnover ratio is not particularly useful. And I'm thinking of companies that make very expensive items, things like elevators and escalators and 18-wheelers and whatnot. So they may not move very quickly, and it may not be a reflection of their efficiency or inefficiency whatsoever. Just maybe the effect of what's going on. But nobody can doubt the idea: the higher the better, right? And if you're able to, if it's the higher the better, it means the inventory you produce is out the door, and so now you can produce more inventory, and that's good. And everyone likes to be busy, and busy is good. So the higher the ratio, the better. And if it's declining, it's not as good because it means the inventory is sitting around for longer for all kinds of different reasons. And again, we don't want to accuse management of being incompetent. Sometimes it's the macro environment that simply is a big issue. So for those of us who lived through a number of different economic recessions, and particularly I sort of cut my teeth in the manufacturing area in the country, the Upper Great Lakes. A lot of these companies really can't do anything about what the macro effects are. Inventory sits around. We have declining inventory turnover ratios, longer days on hand, and whatnot. That's not what they want, but there's not much they can really do about it. So that's kind of what's going on. So, all right, quick quiz here for 2021. Hendrix reported sales of 3.5 million, cost of goods sold of 1.4 million, and net income of 140,000. So we don't need all this information. This is one of the things that we talk a lot about in accounting is you sometimes give them more information than what you need. The company's gross profit ratio for the year is what? Well, all right, so we take net, we're assuming these are net sales, 3.5 million. Cost of goods sold is 1.4, so it's going to be 2.1 million divided by the 350, which is that, right? So it's going to be 3.5 million minus 1.4 million divided back into that, so it's going to be 60%. So the answer is going to be A. That's the gross margin. Gross margin or gross profit ratio, same term. And I know that sometimes we use the terms gross margin and gross profit interchangeably, but theoretically, gross profit is a dollar figure, and gross margin is a percentage. Although if you can obviously use the term gross profit ratio as that. So 60%, pretty good margin, right? Pretty good margin. Now, is that high, low? Is that good, bad? Well, it depends. And this is one of the things that I think we need to emphasize once again is the idea. It really depends upon the industry in which they're operating. What are their peers doing? And by peers, I mean competitors primarily. What are they up to? And are they higher or lower? And that really only makes sense once we do that sort of comparison. And what is the industry average overall? And, as I've said before, that there's lots of data out there that can allow companies to determine and compare their own performance against the industry as a whole, because there's lots of information out there that can establish the industry averages and whether or not those industry averages are how they stack up against them. And furthermore, what their own benchmarks are, because maybe they're trying to recover from some negative events, and so their own benchmarks are that we're going to work our way to industry average and whatnot. So all these are sort of guideposts for management. Okay, and the inventory turn ratio here is simply this. So this is a different example. So Grainger Clothing reported the following in its 2021 statements, and so we have it's an income statement. So we have 1.05 million in sales. Cost of goods sold, which is this figure here, but it's basically, we're sort of using that periodic methodology. Beginning inventory plus purchases equals GAFs, or goods available for sale, minus ending inventory. And so as a result, we have cost of goods sold and then gross profit. But we don't care about, we really don't care about gross profit here. We're mostly interested in the turnover ratio, and that is, well, I mean, I guess we are interested in gross profit, but well, our sales is what we're really not interested in. So the idea is we're going to take cost of goods sold divided by average inventory. That's what inventory turnover is. So cost of goods sold is 630. What is average inventory? Well, we talked a bit about this last time, where you can do whatever makes sense for you. Beginning inventory plus ending inventory added together divided by 2 gives it an average. The problems with that are the idea that, you know, maybe the inventory is low at each of these fiscal years, because remember, beginning and ending are 1 day apart or 1 second apart, really, right? Separated by a year, but nonetheless, there's a cyclical aspect. So, and maybe a company chooses that particular fiscal year end because of the fact that the busy season is gone, particularly for very seasonal businesses. And so, yes, beginning inventory, maybe January the 1st of 2018, and the ending inventory is December 31st. Those are not 1 second apart. But what I'm saying is the beginning inventory is the ending inventory 1 second before the last year end. And it is essentially reflective of the fact that you may have a down period. So maybe that's not good. Maybe a better way to go is to capture that busy period by taking maybe the 15th of the month of every month in 12 months and add those up divided by 12. Or I have seen, regrettably, it's my misfortune, to have seen every ending inventory balance divided, summation, summed all together, which is very easy to do on computers and Excel, and divided by 365. And that gives you the average inventory method. So I've talked a bit about this before. So there are some limitations, but I think we ought to be aware of what's going on. So in this case, we're just going to go with what's given, January the 1st and December 31st, 205 plus 215. Well, this is not hard because you can kind of eyeball this and say, well, the midpoint between 205 and 215 is going to be 210. That's going to be average inventory. So cost of goods sold 420 divided by 210. Well, the math is simply and simply easy. I'm sorry, cost of goods sold 630 divided by 210 is going to be 3. So what does that say? It says that we turn over inventory 3 times a year. Okay, 3 times a year, and that's an average figure. Maybe some inventory is faster moving than other inventory. We get that, and if you really want to break it down by individual product line, you can do that, right? And that's what management is expected to do. It's what managerial accounting often does, is account for these differences in turnover speed. Faster is better, right? Typically, right? Assuming you can meet the demand and turn the inventory over quickly. Again, inventory doesn't do anything but eats up cost over long periods of time. And so we want to be clear about what's going on. Okay. All right. So we got about 20 minutes, and we want to get into sort of the more complicating factors here with regarding LIFO. And that's where we talk about some of the issues that are intended to simplify LIFO. And sometimes people say, well, wait a minute, this is not simplifying at all. But let's try to present it in the sense of what the logic is behind a couple of different methods by which we derive LIFO accounting. So remember, we're talking about last in, first out, oldest goods are the ones sold first. And how do we do that in a rational sense? And there are a lot of different methods. And among those are the idea of what we call pooled LIFO. We create pools of assets in this case. And by the way, accountants love to create pools of things, pools of assets, pools of liabilities, pools of debt, whatever the case might be. And so in this case, this is a pool of inventory. And we're going to group inventory together based upon some common characteristics that make sense for why we would pull them together, and to sort of simplify the accounting, because we're going to sort of take an average of these within the pools, average cost within the pools. Otherwise, it would be endlessly nightmarish in terms of going forward. And then something called dollar value LIFO, which really accounts for the idea of the fact that it recognizes the fact that prices are going up over time. In other words, costs of the firm are going up. As a result, how do we separate the value of inventory based upon quantities, or that which is simply due to price changes? And that's what dollar value LIFO deals with. And dollar value LIFO is kind of cool. It kind of is a little bit unusual and not all that familiar to a lot of people, but we'll try to demystify it a little bit. So first, let's talk about LIFO pools. So that's the first one we're going to talk about here. And so what we're doing is we're sort of grouping inventory units all together based upon whatever characteristics make sense. That is, they tend to be the same item for the most part, and we try to do our best to sort of group these because they're essentially the same item. We're really talking, I think, primarily about commoditized items, and by commoditized, I mean that one can't distinguish the value of one thing from another, right? They pretty much are the same. The buyer is mostly indifferent as to those, can't discern a difference. Whether these are perishable or not, we're really talking about the idea that buyers are indifferent. So if they're indifferent, so are we. But we're really talking about the supply side here. And what we're saying is we're going to sort of group these all together based upon the common characteristics. And so what are we talking about in terms of common characteristics? Inventory pools are things like this. Maybe it's all 2x4s in a home goods store. And that's one pool altogether. And so as a result, we take the average cost of those based upon purchases and whatnot. And then 2x6s may have their own particular pool. And I know the lumber, for whatever reason, I've seen a ton of intermediate textbooks. Lumber is always a big one that comes up, but it's a good example, right? So 2x4s are distinct from 2x6s, distinct by 2x10s and whatnot. So we're going to group those differently within a pool themselves. Otherwise, I mean, it would be a nightmare to track every single 2x4 that comes in and say, what did we pay for this 2x4 or these 50 2x4s on this pallet versus the other 50 pallets we bought during the accounting period, or whatever the case might be. So pulling them together makes a lot of sense. And from within that, then we apply the average cost method, but still employing the broader scheme of LIFO. Okay. So that's what's going on. So within the pools, they're considered to have been made at the same time and at the same cost. Therefore, we simply take an average cost of those. And we'll get to some examples here. And so if the quantity of any inventory goes up, then we simply take the beginning inventory plus that layer added during the period at the average cost of the pool. And if you're kind of confused as to what that means, let's hold on. So what are some others? Before we move on, what are some other examples? They can be, I mean, the list goes on and on and on. Particularly in a sort of manufacturing environment where you've got lots and lots of inventory that's pretty much the same and nobody can really distinguish it. And you just want to dump it into a pool, an inventory pool, in order, and as those pools are being used up, then we sort of recognize those based on a LIFO example. So some other examples are things like your plumbing contractor, maybe all PVC piping goes into the one pool, right? As opposed to maybe copper piping or some other material, right? So that might be one example. Any other number of commoditized products, things like fruits, vegetables, nuts, whatever, that we can sort of dump into. And again, we say commoditized products tend to work best here. If they're more standardized or suited to the needs and demand of a particular buyer, then this is probably not the most applicable method. But we're really talking about high volumes of goods, and we're trying to sort of group these into pools. And it's a logical system that allows us to do the best accounting for what's going on here. So, all right, so let's talk about some examples here and see what's going on with pooled LIFO. So we have diamond lumber, again, back to the lumber example. I mean, it's a great example, it really is. They have rough cut lumber inventory that includes 3 types: pine, oak, and maple. All right, so whatever, however you want to define it, it's fine. I just use 2x4s, 2x6s, 2x10s. In this case, pine, oak, and maple. So we have beginning inventory, and board feet is simply a industry measure in times the cost per foot. So this is quantity times price gives us the total cost. Quantity, price, all the way across. So if you take 98,800 divided by 40,000 units, so it's price or cost divided by quantity, gives us 247 per board feet. And that's a layer of inventory based upon that. And we're assuming that we're sort of grouping these together for whatever particular purpose, right? And maybe they go together, maybe they don't go together, but in this case, this is what we're sort of doing here, right? So we have 247 as a unit cost per unit, and the units are based upon board feet. So let's go forward with this. And so the next reporting period, the next year or whatever, Diamond purchased 50,000 board feet of lumber, and they sold 46,000. Okay, so here's what we're doing, all right? So they started out, let's go back to where we were before. We had this element of 40,000 board feet at a cost of 98,800. Now we're going to purchase 50,000 more units, and it's going to be based upon this distribution here. And so now the average cost of this purchase is 254 now per unit. Now we're assuming this is a perpetual system, right? where we update the cost of goods based upon these every new purchase of inventory. This would not make sense for a periodic system, I don't believe. So as a result, this new layer of inventory is 50,000 units at 254 per unit, even though there's sort of a diversity of goods that are lumped in this pool. And it's not for us to decide here as outside analysts whether or not these pools make sense. It's just that the pools exist, and this is kind of the way we're doing it. So, all right, but what is the important factor? Because we want to get to this idea of LIFO. Remember, we are talking about LIFO here, and we're talking about liquidating inventory. So 46,000 units were sold. So what's going on here? We had beginning inventory of 40,000, and we added another layer of 4,000 because why? What's the difference between 50 and 46 is 4,000. So it's that newest that we add as a layer of inventory. We sold 46,000 of this 50,000, so we added 4,000 at a unit cost of 254. So as a result, the new ending inventory is going to be 44,000 units at, well, it's simply line times price, 108,960. Okay, so that becomes the ending inventory if that's the only activity that happened during that accounting period. And you might think, well, that's not realistic. One purchase and one sale. Does that make sense? Well, okay. Well, then, if that doesn't make sense, let's keep on going. Let's add more purchases, more sales, and the same logic will apply. And as we are dipping into previous layers of inventory, we're going to be liquidating inventory, but we're going to keep the unit cost that applies to that particular layer. And that's really what's going on here. Is the idea. This is why LIFO accounting is trickier. It requires lots of good bookkeeping or accounting because you've got to sort of understand what those unit costs are so that we can get a good cost of goods sold figure as we go forward, right? So that's essentially what's going on there. So, okay. So again, that's the ending inventory figure that we arrive at. So, okay. And if you have questions about that, feel free to get with me. I'm more than glad to talk about what's happening there. Okay. So one final thing here is rather than assigning cost to each individual unit of inventory, I think that's really it would be a real disaster, really just difficult. Maybe at some point, maybe. I know there's been some academic literature that says every individual good at some point will have a specific little QR tag, and we can do specific identification for every single nut, bolt, screw, whatever, and we can tag it. But we're not there yet. And by the way, even if we are there, how do we tag things like liquids, lubricants, and paints and varnishes and whatnot? I think it's really difficult to do, and so we have to use one assumption or the other: FIFO, LIFO, average cost, and whatnot. There are a couple of other methods as well, but we have to use some sort of cost flow assumption. And in this case, we're using LIFO. Establishing pools, just sort of simplify it because we're simply saying all these that are like together we're simply going to take the average cost, but we're going to create a layer within that cost. And then as we liquidate those layers, we will account for the value of cost of goods sold as we go forward. Okay. All right. We have about 8 minutes left. Let's talk about dollar value LIFO. So what is DVL? Dollar value LIFO is an interesting concept. And it really makes a lot of sense, particularly when prices are rising. Now, remember, LIFO in general is based upon the logic that prices are rising, so therefore firms are incentivized to use LIFO simply because of tax issues. But we're talking about the idea that we are distinguishing the quantity increase or decrease, that for that matter, in inventory versus that increase, which is simply made up due to price level changes. And that's really what's going on here. So we sort of go back to macroeconomics, and I know that not everyone here has probably taken macro yet, but if you haven't, think about what's going on here. That we're going to establish some basis for a price level increase. And we're going to assess any kind of change in inventory for whatever the inventory category is based upon how much of that is due to the change in the price level versus the change in the quantity level. And it's really a means of sort of simplifying our example. And dollar value LIFO, we're only really sort of scratching the surface here in this course, but it's really an important topic and it's used fairly frequently. So this really allows us to see changes in value due to changes in price or change in quantity, right? So what we have to do is we have to deflate prices based upon inflation. So, and if you've taken macro before, you'll note we have something called a deflator, which is simply some sort of index, whatever it is, consumer price index, producer price index. There are all kinds of price indexes. This is what economists do, is create price indices. I've known lots of economists over the years who will create an index for whatever it is you're trying to do. I knew a guy who did an index for copper production in Arizona, only for that particular area, only because they wanted to establish a price index so they could understand what the increase in price was versus the increase in quantity. So you take the cost in whatever the year is, divided by some base year, which is some previous year, and you're going to have a number. And that's going to be the cost. It's going to be a number that goes from 1 to whatever, right? If the prices were the same, right, or the costs were the same, then it would be, the answer would be, if it's 100 divided by 100, it's going to be 1, right? So, or 1.0, whatever the case might be. If it's 105 and this is 100, it's good. 105 and this is 100, it's going to be 1.05, right? And so that's simply a number. That's what price indexes do, is refer it back to some base year. And it's usually based on this 100 scale. If you don't like the percentage, you can move the decimal 2 points to the left to get an actual number like 1, which is the same as 100%. But it's a quick and dirty way of saying, okay, if the index is 138, it means the prices since the base year for this particular inventory measure are up 38% since that base year in general, okay? I'm assuming the data is good and all that sort of stuff. And so, and oftentimes these indexes are either published and widely available or computed specifically for that firm. And microeconomists will often do it, particularly for bigger industries that really want to know exactly what's going on for their own particular business. And so that's essentially what's happening. So here's the process. We're going to convert inventory to base year costs, which we just talked about. And we're going to identify the layers of it in the inventory created each year. And we're going to recreate those based upon the cost index based upon that refers back to some base year. Okay, so maybe some examples. The best way to go here, I think it's probably the case where examples are the best. So, and we're almost out of time here. So Haynes Company adopted dollar value LIFO on January the 1st, 2021, when the inventory cost was $400,000. 2021, in the inventory value, year-end costs at $462, and the index was 1.05, meaning that during 2021, prices for those goods went up 5%, or prices in general went up 5%. I know that sometimes using some broad macro measure like CPI, Consumer Price Index, or even Producer Price Index may not be applicable, but it's whatever is used by the company, and they've got to justify it. And as long as they're consistent, then that would seem to be particularly fine. If it's not a good index, well, then well, it's like a lot of things. If it's not good, it's not good. So you've got to kind of change your ways. But in this case, what do we have? We have 462 at year end, divided by 1.05 gives us 440,000. That's in the inventory that we have done what? We've discounted, we've deflated. We've taken out the effects of inflation, the 5% inflation rate. Why are we doing that? Because we're trying to separate out what is due to quantities, what is due to price. So in this regard, we had 400,000 beginning. We had the new layer was 40,000, so 440,000 altogether. So obviously, if this is the base year, 2021, then the index is going to be 1, 400%, so no change there. But here, we're going to take this difference here, and we're going to multiply that times 1.05, and we're going to raise that. And so we're going to raise the ending inventory at the cost of that, simply to account for the price level changes that have gone on. Why are we doing this? We're doing it in order to separate out what is the change in quantity versus the change in simply dollar value, which is why it's called dollar value LIFO. And inflation is essentially the depreciation of currency. If it takes more dollars to buy the same goods as did a year ago or whatever, then it means that the value of that currency is going down over time. So, all right, quick quiz here. We only got a couple minutes. Is December 31st, 2021, Burroughs adopted dollar value LIFO. Inventory at the end of 2021 was 600,000. At the end of 2022, which is a year from then, inventory cost was 806,400, and the index cost was 1.05, meaning that prices in 2022 went up. Prices of their inputs went up by 5%. We don't know what the index was based upon. We don't care in this case. All we're trying to do is solve for the ending inventory at the end of 2022. So here's the solution, right? So we're going to take this dollar figure here, right? And 806,400 was the ending inventory. We're going to divide it by 1.05. That gives us 768, right? And the increase is going to be 168,000. That is between 600,000, which is beginning inventory, and 768, which is ending inventory. We have $168,000, which we're then going to multiply by that multiplier, 1.05. Where does 1.05 come from? It's the index value, or the index number for that particular year, 5% inflation. We're going to multiply by that, and then we're going to end up with ending inventory that is computed as beginning inventory, which obviously in this case is 100%. And then the first year they adopted it, and then this times that, which is 168 times 1.05, is 1,764. And so this is the number for ending inventory that we're going to end up, and that's the number that we'll report using that particular method. Now, here's the big question. I know we're almost out of time, but who would benefit from the use of this? Well, this is particularly useful during rising cost environments. And by the way, I keep coming back to this idea that if it's a publicly traded company, that analysts are able to disentangle this, presumably, they're able to figure this out. And if it doesn't make sense, and sometimes companies may make a bit of an error, and analysts will sometimes report and say, "Hey, there's an error here," and they'll have to check it. But usually, this is parsed over pretty well before numbers are done. And if somebody wants to disentangle this and say, "Okay, remember, we can go from LIFO to FIFO if we want, because we want to do it." Well, we have to understand what method of LIFO is being used here. And dollar value LIFO is particularly useful, particularly when you want to sort of separate out the change in inventory balances between beginning inventory based upon not just quantity increases, but price level increases. You take the price level increases out, and that's essentially what's happening. You're separating the two out is what's going on. Okay. All right. So, any questions for me before we wrap this up here? Obviously, if you have questions about anything regarding Chapter 8, homework or quiz, let me know. I'm available to answer your questions. Regarding the exam, let me know as well. And if you have difficulties in the exam in terms of technical issues, let me know. We don't often have problems, but sometimes it's a different system where that you're working with in Connect. So if you do have issues or whatever, just let me know, and we'll work it out. And I'm more than happy to help. So, okay. Well, everyone have a happy Halloween, and I will see you all next week.